What's going on, guys? Welcome back to my channel. I hope you're all doing good and having a great day. Now recently I've been asked a lot of questions by you guys about investing in the stock market and how best to invest as a beginner and what areas to look at within the market. So today I thought it would be interesting to go over exactly how I would invest my first £1,000 if I was to start investing in the stock market now from scratch. Now this would be from a beginner investor's mindset, focusing on the simple investments that you can make, rather than going into a whole range of different investment opportunities, which makes the whole thing a bit more complex. So I'll be explaining exactly what type of market I'll be investing in, what sort of investments, which investment platform I think is the best out there for beginners at the moment, and exactly how I would split the money across different investments with a plan going forward. Now I just want to make this really clear, this is simply just how I would choose to invest £1,000 if I was starting out as a beginner. In no way is this advice telling you guys that you should go and invest in these things. These are just things I see value in and the approach I would take. That being said, with this investment strategy, I believe it can outperform all of the do-it-for-me investment platforms out there like Moneybox, Nutmeg and Wealthify, as well as outperforming the UK indexes. Now just before we get into it, if you guys are new around here, welcome to the channel. This is the place to be for all things finance and money related within the UK. So on this channel I'll be going over all of the most relevant information when it comes to investing, what are the best bank accounts and credit cards out there. So if you're not already, I'd really appreciate it if you could hit that subscribe button down below and click that bell so you never miss a video. And I know it is a bit cheeky asking before the video's even started, but I'd really appreciate it if you guys could smash that like button, as it does really help me out with the YouTube algorithm and enables YouTube to share these videos so that more people that might find them useful or interesting get to actually see them. But with all that out of the way, let's get into the video and start looking at this investment strategy. So as I briefly touched on, the stock market can be very daunting as a beginner investor, as there's so many different things that you can actually invest in, and to be honest it's quite difficult to cut through all of the unnecessary stuff that you need to understand and learn to actually get to just the simple factors that enable you to make money. So I think starting as a beginner, it's a lot easier to focus on one small area and then expand once you've grown your confidence and start seeing some positive returns. Now the idea of this investment strategy is that it will make you money over a long period of time, and it doesn't involve any short-term trades, it's more of a long-term growth strategy. So you can think of it as an alternative to a savings account. Now due to the impact of the pandemic and the cut of interest rates and higher inflation rates, a lot of savings accounts out there at the moment are actually losing money. So if you put your money into a savings account, due to the inflation rate being higher than the interest rate, the value of your money will actually be less and less every single year, which is really not what you want. So investing long term is a really great alternative to this, in my opinion. So where you might be getting less than 1% in interest on your savings account, I believe on average you can make 10% or higher every single year. Right, so with all that out of the way, let's start looking at the fundamentals of what we actually need with this investment strategy. So the first thing you're going to need is an investment platform. Now there are so many different investment platforms out there for UK users which all have their own benefits. But with that being said, I think the best platform out there for beginner investors with potentially a smaller amount of capital to invest, the best platform you can go for is Trading 212. Now my reasoning behind this is that it's a fee-free investment platform. So whereas a lot of other investment platforms will actually charge you every time you buy some shares, Trading 212 is actually completely free. So it's really good for those starting out with a smaller amount of money, so that your total account value doesn't get eaten away by trading fees. So with Trading 212, there's no trading fees, no annual fee, no top-up or withdrawal fee, and no inactivity fee. The only fees you'll have to pay for are on certain types of investments, which will be consistent across any investment platform. So there are a few different account types when it comes to setting up a Trading 212 account, but the ones that are appropriate for this investment strategy are the Invest account and the ISA. Now if you don't understand the differences between these types of accounts, I'll leave a link down below and on screen now to my video going over the differences between different investment account types, which should explain everything. Now if you are interested in getting a Trading 212 account, I'll leave my referral link down below, where if you sign up through that link, as soon as you fund that account you will get one free stock valued up to £100. And the great thing is you can actually sell that stock instantly and then withdraw the cash if you want to. Alright, so now we've got an investment platform to use, let's now look at the type of investments we're going to go for. So within the stock market, there are a whole range of different types of investments you can actually invest in. So for example, you can invest in an individual company, or there are actively managed funds like investment trusts or unit trusts. But today we're going to be exclusively looking at index funds, which are bought in the form of an ETF or exchange traded fund. Now this isn't to say that I don't see any value in other sorts of investments, I just think that ETFs are a great simple way to start when investing in the stock market. And then you can explore other opportunities out there once you have a bit more confidence. Now another great thing about UK ETFs is that you don't have to pay stamp duty when you buy an ETF. So whereas if you're buying shares in individual companies or investment trusts, you actually have to pay 0.5% in stamp duty for doing so. So this is another reason why I think ETFs are great for when you're starting out, because it simply just keeps the costs down for you. Okay, so now we've looked at what type of investments we're going to go for. We need to find a market that we're going to invest in. Now, if you're not familiar with what an index or an index fund are, I'll briefly run through that now. So within the stock market, indexes are basically created to split up companies listed on the stock exchange into sectors. So this could be based on where the companies are located or the type of companies they are, so for example tech or industry. So for example, within the UK market, there are a lot of different indexes within it. So there's the FTSE 100, which tracks the 100 largest trading companies within the UK. So what an index tracking ETF allows you to do is invest into the index without having to buy shares in all of the companies listed within the index. So it makes it a lot easier for me and you as an investor. So now we know what type of investment we're going to go for, we now need to find a market and an index to invest in. So everyone has their own opinion about what are the best investments out there and what you should avoid and what you should go for. And a lot of people talk about diversification of your portfolio and how you should spread your investments out across different markets. I personally just don't really agree with this. I like to find markets that I see value in and basically just not bother with anything I don't see a lot of value in. But the good thing about index funds is that by nature you're actually investing with one investment in a whole range of different companies. So in a sense you're actually getting a diversified portfolio within one investment. So generally the main thing I'm looking for is a consistent uptrending pattern over a long period of time with high percentage growth on average every year. So for example this may be around 10% or more. And to me the US markets do a good job of this, and there are certain indexes where I see a lot of value in. So the first one is the S&P 500. Now the S&P 500 is made up of the 500 largest trading companies on the US stock exchange. So it contains a whole range of different companies, but the one thing they all have in common is that they're the 500 largest trading companies. So we can use Google Finance to analyse this, and from looking at the graph it has a consistent uptrending pattern and it's fairly resilient to market fluctuations, for example the recent pandemic where it's recovered actually fairly well compared to a lot of other world markets which haven't done so well. For example, the FTSE 100 in the UK has not recovered in nearly the same fashion. And looking over a long period of time as well, the index has performed fairly consistently and continued to uptrend throughout. Now on average, the S&P 500 generates between 8 and 10% every year in growth. So some years it might be more, others it might be less, or some years it may even lose money, but on average it generates that percent of growth. So I like to use the S&P 500 as sort of a benchmark, and I personally look for investments that perform in a similar way to the S&P 500 or better. A great way to compare different indexes and different investment opportunities is using Google Finance. So if you type in the index or investment you're looking for, you can simply compare it and see how they compare over time as well. And it will show you exactly how much percentage of growth it's had over whatever period of time you're looking at. And it's really useful to just get a simple gauge of how something's performing. Now another index I personally see a lot of value in is the NASDAQ 100. So this is sort of similar to the S&P 500 as it contains some of the same companies and it's made up of companies listed on the US stock exchange. But the main difference is that it doesn't contain any financial companies. So there's a higher proportion of shares based in things like tech, motoring and retail. So within this you'll see companies like Apple, Amazon, Microsoft, Facebook, Google and Tesla, just to name a few. So when comparing this to the S&P 500 using Google Finance, you can see that it's got a very similar trend. However, it just has more growth over short and longer periods of time. And if we look over a 5-year period, if you invested your money 5 years ago into the S&P 500, that money will have increased by 76%, and whereas if you invested in the NASDAQ 100, that money will have increased by 176%, which to me signifies that it's got a lot of potential and a lot of value. Okay, so those are two indexes which I personally see value in. So to invest in those indexes, we now need to find an ETF index tracking fund. Now I think one of the simplest ways to do this is to use the Trading 212 app itself, and you can search specifically for ETFs and then just type in S&P 500 or NASDAQ 100, and then some index funds will pop up which are designed to track the index performance. So you can simply just invest in these. Now there are usually a few different options when it comes to picking an ETF. So there are different investment companies, for example Vanguard, iShares, Invesco and many more. And basically one of the ways I like to narrow it down is to simply just compare these again on Google Finance against each other and see which is performing closest to the index it's supposed to be tracking and which performs better against each other. So for example, if one S&P 500 tracker performs better than another one, I would usually go for that one. Another thing I like to do is to look at the volume of shares being traded. So to do this, I go on the Hargreaves Lansdown website and look at the specific ETFs that I'm comparing, and it tells you exactly how much volume these shares are being traded at. So what I like to go for is one that's being traded at a higher volume. So what volume means, it's just the quantity of how many people are actually trading the shares. So you want to have a high volume, so there's a lot more people buying and selling the shares on a day-to-day basis. So it makes it easier for you basically to buy and sell when you want to, as there should always be a buyer or seller. Another thing I always like to do is to find an ETF that's valued in the same currency that I'm trading in. So for example, I'm trading in pounds, so I want to find an ETF that is valued in pounds rather than dollars, just because it makes everything a bit less complicated. It's also worth noting that all of these ETFs do actually have their own fees that they charge, so you can view this all on the Hargreaves Lansdown website as well. So for example, this S&P 500 tracking fund from iShares with the ticker IUSA charges 0.07% each year as an ongoing charge, which is basically just a way that iShares makes some money. And these fees are basically completely unavoidable and just vary depending on which investment you go for. So it's worth comparing these if you're looking at similar sort of investments. So with all this in mind, I'm going to go for IUSA as my S&P 500 tracking fund. And I'm going to go for EQQQ from Invesco, which is designed to track the Nasdaq 100. And from comparing these two against the indexes they're supposed to track, they do a fairly good job compared to other things out there, in my opinion. Okay, so now you're probably wondering, what proportion am I going to invest of my £1,000 into these funds? So I think a good way to go to split up the cash is to go 50-50 in each, as it allows you to see how they perform over a period of time once you've invested, and then you can always readjust later and sell some and buy some more of another if you want to. But with that being said, I think one of the most important things when it comes to investing is to carry on investing and invest consistently. So I'm not just going to invest that lump sum and then leave it and wait for it to grow. I'm going to continue to save consistently every single month, and of that money that I've saved, continue to reinvest into these shares and maybe other investment opportunities that I see value in other markets. Now when it comes to timing and when to actually buy these shares, I think the best thing to do is just to consistently buy every single month, but just focus on finding a down day, because I don't think you want to be buying in when something's at a high price when the next day it might drop, because the market's constantly fluctuating. So I think it's best to invest consistently, but find down days to invest in. But the good thing is, even if you do buy potentially not on the best day and it's slightly up on a day that it was previously, we're looking at finding things that are a good long-term investment. So over time it's not really going to make much difference. And like I said, over time the whole goal is to just simply keep adding to the position as long as you still see value in the investments, and simply just hold them for a long period of time, and every single year they should increase in value by a significant amount. That's much more appealing than something you might be able to get in a savings account. Now it's also important to remember that the market does fluctuate quite a lot. So for example, there are market crashes but also positive spikes. Now the thing to make sure is that you don't panic and sell your shares at a loss if there is a market crash. Rather just see it as an opportunity to buy more. As from looking at previous market crashes, these markets tend to recover fairly well, so it is just a good buying opportunity to get in at a good price, and then you'll be able to make more money once it recovers. Because if you sell once it started going down, you simply just guaranteed yourself a loss. So it is really quite simple. You just buy, hold, and keep reinvesting. And over time you should see some pretty consistent profits. So there we have it. That basically covers everything for today, guys. I hope it was helpful in giving you an understanding as to how I might invest £1,000 if I was to start out investing in the stock market now. And I hope it was quite straightforward to understand if you are a beginner investor. And with this investment strategy, I genuinely believe something this simple can outperform the do-it-for-me platforms out there and a lot of other UK markets. Because the good thing about investing in the stock market is that it doesn't need to be too complicated. You can just simplify it down into certain areas and just simply ignore other things that you don't see value in. But that being said, these are just my opinions, and this is how I would choose to invest £1,000, and you don't necessarily have to agree with my investment style. Also, I just want to reiterate, my current investment portfolio is a bit more diverse than this, and I have a lot more other investments which are not ETFs, but I just think that ETFs are a good way to go as a beginner investor, as you can gain some confidence, see some positive gains, and then look at other opportunities out there. Now if you did make it this far, thank you so much for watching, and if you did enjoy the video or feel like you learned something new, I'd really appreciate it if you guys could smash that like button, as it does really help me out and helps out with the YouTube algorithm and enables YouTube to share these videos to more people that might find them useful or interesting. And if you are new around here, make sure you hit that subscribe button down below and click that bell so you never miss a video, because this really is the place to be for the most relevant information on UK finance in a streamlined, manageable way. Now if you do have any questions or feedback for me, make sure to just drop them in the comments down below and I'll make sure to respond to all of you. But with all that being said, take it easy guys and keep saving.